So you want to know how to pay your mortgage for free. Well, in this video, I'm going to give you the complete playbook on exactly how to do just that in just 3 simple moves. If it sounds like a scam, it isn't. I've closed over 400 loans and more than $100 million in financing as a mortgage broker and gotten regular first-time buyers into homes that pay for themselves without a big pile of cash to start. And this video's focus is to show you how you can own a place that doesn't cost you a single penny out of your own pocket. Now, the truth is that most people who watch this video will nod along and never do a thing with it. But for the few who follow through, a home that pays for itself is a lot closer than you've been told. And this is how you can get it. Now, before I give you the first move, you need to be clear on what free means here. Because free doesn't mean that the mortgage magically disappears or that there's some loophole where you stop owing the money. You still owe every single dollar of it. Free just means that the payment never comes out of your pocket because you set the home up so someone else, like the tenant or the government or the seller, pays it for you. And when you let that home earn even a little, the whole payment lifts right off your plate. Now, there are 3 moves that pull this off. You can run just one, or you can stack them. But the more you stack, the less of that payment lands on you until it's covered. I'm gonna give them to you in order. From the one that you can start on your very first place to the advanced one that takes the payment to 0. So make sure you stay until the end, and if you enjoyed this content, subscribe to the channel and let's get into it. All right, so move 1, and it's the most powerful of the 3, especially if you're buying your first home. It's called house hacking. And the idea is simple. Your first home doesn't have to be a house that you pay for, but it can be a small building that pays you instead. So instead of buying a single family house to live in, you buy a small property with 2, 3, or 4 units, a duplex, a triplex, or a fourplex. You live in one unit and you rent out the others. So let's say you go and you find a duplex and it costs you around $500,000. You'd buy it with an FHA loan, which is just a government-backed loan built for regular home buyers. And it only asks for 3.5% down payment. So you're getting into the whole thing for about $17,500. Then your monthly payment, once you add up the loan, the taxes, the insurance, comes out to somewhere around $3,500 a month. Now, you live on one side and you rent the other side out for say $2,400. So your tenant is covering $2,400 of that $3,500 for you, which means that you're paying $1,100 instead of $3,500 for a place that's yours. And if you go bigger, a triplex or a fourplex, those extra units can cover the whole payment and then some. Though the exact loan limits depend on where you live. And it gets better. Because those units help you before you even buy, when you go for a 2 to 4 unit place you're gonna live in, there's a rule that lets you count a big chunk of the future rent as income, usually around 75% of it. So those other units aren't just covering the mortgage after you move in. They're helping you get approved in the first place for a property that your paycheck alone would have never qualified you for. That's a 75% rule, and it's the reason a regular paycheck gets you into a place it never should have. So now, your home is the thing that pays you instead of the biggest bill that you've got. Now, is it for everybody? Absolutely not. It means being a landlord and living right next to your tenants. But it's the most powerful move on this list, and you can do it on day 1, on the very first place that you buy. So that's move number 1. A tenant covers your payment while you live there, and you barely feel it. Now, move 2 is the complete opposite idea, and it's the one that almost nobody uses right. Here, instead of finding money to cover your mortgage, you just shrink the mortgage itself, and you get the seller to hand you the cash to do it. That's called a seller concession. And the way it works is pretty straightforward. The seller agrees to put a chunk of money towards your side of the deal, and it comes straight off what you owe at closing. Depending on your loan and your down payment, that can run up all the way to 3 to 6% of the price. So on a $400,000 home, even the low end, just 3% is 12 grand handed to you. Now, most people take that 12 grand and dump it on their closing costs. And that's fine, but it's just a small way to use it. Because that same money, if you point it at the right thing, can permanently buy down your interest rate. And permanent is the key word here, because there's a temporary version of this that only lasts a year or two before your rate climbs right back up. This one doesn't. Your rate stays lower and so does your payment for the full 30 years. On a loan that size, pointing that 12 grand at a buy down can shave well over $100 off of your payment every single month. And that stacks up fast over 30 years. So now the rent from your other unit isn't just covering part of the mortgage. It's covering the whole thing because you shrank the bill it had to beat in the first place. And before you go thinking this is some rare unicorn deal that you have to dig around for, it isn't. Right now, close to half of all sellers are handing out concessions just to get their place sold. That's the seller lowering your payment for you for years, and almost nobody even thinks to ask for it. Now, on its own, this move won't make your mortgage disappear. It just makes it cheaper. But cheaper is the whole point, because that's what lets the rent from one move go from covering most of your payment to covering the whole thing. That's how these work. You stack them. One move brings the income in. The next shrinks what that income has to cover. And somewhere in the middle, that stops being your payment. Now, before I give you the last move, just know that which of these fits you comes down to a single fact: the loan that you qualify for. And that's different for every single person watching this. So if you want my team and I to look at your numbers, your income, your credit, the kind of place that you're after, and just tell you straight up which of these moves fits you and how to run it, I'll leave a link in the description below where you can book a free consultation with our team of experts. All right, so at this point, someone else is already covering most of your mortgage payment, maybe even all of it. But everything so far has come from one single property, the one that you live in. So the last move sends it outside of your own four walls completely. Instead of squeezing income out of your own home, you go buy a completely separate rental property. And that one throws off enough profit to cover the mortgage on the place that you live in. I like to call this the graduation play, because this is the level where you stop thinking about your mortgage entirely. It's just no longer your problem. Now, of course, when I explain this to people, there are usually two questions popping inside of their head. And these questions, they go something like this: how do I even qualify for a second property? And how on earth do I afford it? So let's go through both of them one at a time. First is qualifying. And there's a loan built for exactly this. It's called a DSCR loan. DSCR stands for debt service coverage ratio, which is just a really fancy way of asking this: does the rent cover the mortgage? Now, with this loan, your job, your tax returns, your personal income, it doesn't really matter because the property qualifies on its own. So if the rent covers the mortgage, you're in range. Okay, and then question number two, affording it. Most people think that they need a fresh pile of cash sitting in the bank for the down payment. But in reality, you really don't. What you need is equity in the first home that you already own. So once your first home has built up some equity, you pull it out with something called a cash out refinance, which is just swapping your current loan for a slightly bigger one and pocketing the difference in cash. And because that cash is technically a loan and not income, it's generally not taxed. So that money becomes a down payment on the rental, and property number one literally funds property number two. So at this point, we've got the loan, we've got the down payment, and we've got the rental. There's one thing we're missing. It's the tenant. And the tenant is really the engine of the whole thing, because the entire play only works if that rent check shows up every single month. So what you want is the steadiest tenant that you can possibly find. But what most people don't know is that the steadiest tenant on the planet is the government. And this is where Section 8 comes in. Now, if you've never heard of Section 8 before, it's a government program where a big chunk of the rent gets paid directly to you by the government on time every single month. So instead of relying on some random person to pay you on time, you've got the government sending you the check. And it gets better. The government publishes exactly what it pays. For every zip code, for every bedroom count, that number is just sitting there publicly. So before you ever buy the property, you're gonna look up what a 3-bedroom pays in that exact zip code. And you're gonna know your rent number before you even make an offer on a property. So let's just say, for example, you look up your zip code and the government pays you $2,200 a month for a 3-bedroom. And let's say the mortgage on that property comes out to $1,600 a month. That's a $600 spread paid by the government every single month. And you knew that number before you ever bought the place. Now, to eat my own dog food here, I own one of these Section 8 rentals myself. I picked it up cheap. It rents through Section 8 and that check hits every single month. And when you take that kind of spread and point it at your own mortgage, your home becomes something a whole separate property just pays for, instead of being one of your biggest expenses. Now, again, none of this is free money. That mortgage is always owed, and every single month, somebody is paying for it. There's just no way around that part. Everything that I just showed you is making sure that that somebody isn't you, but a tenant, the government, or the seller himself. So now you know the 3 plays that get your entire mortgage covered by somebody else. But even if you run all 3 of these perfectly, there's still one thing that can stop you before you ever start, and that's getting approved for the loan in the first place. Because most people fundamentally misunderstand why a bank turns them down. So watch this video next, where I'll show you exactly why banks say no and how to get approved for the loan you want even after one already has. So you can go run these plays in real life.